Welcome to today's episode. We are looking at a market that appears to be standing at a very significant crossroads. On one hand, we have the relentless march of technological innovation, particularly in artificial intelligence and cloud infrastructure. On the other hand, we have macroeconomic pressures, sticky inflation, and shifting interest rate expectations that keep investors on edge. It feels like trying to run a sprint while wearing heavy boots. Where do we even begin to find true value in this environment?
It is a fascinating setup. When you look at the current market, the noise can be absolutely deafening. Every single day, there is a new headline claiming either a massive market crash is imminent or that we are on the verge of the greatest bull run in history. But if you strip away the noise and look at the underlying data, a different story emerges. We are seeing a massive divergence between companies that are merely riding the wave of hype and those that are actually generating robust cash flows and building real defensible moats. That is where our focus needs to be.
That distinction between hype and actual value is crucial. We often see retail investors getting caught up in the excitement of a rising stock price without looking at the balance sheet. In our analysis on the US Stock Picker podcast channel, we frequently emphasize the importance of looking past the marketing slides. If we look at the technology sector right now, what are the specific indicators that separate a speculative bubble from a genuine growth opportunity?
It really comes down to unit economics and capital efficiency. During the easy money era, companies could burn cash indefinitely to acquire market share, and Wall Street would reward them for top line growth. Today, that game is over. Investors want to see a clear path to profitability, if not outright positive free cash flow. A great metric to look at is the Rule of 40 for software companies, where the sum of their growth rate and profit margin exceeds 40%. If a company can grow at 30% while maintaining a 10% free cash flow margin, they are demonstrating true operational efficiency. That is the kind of baseline strength we need to look for before even considering the stock's future upside.
That makes perfect sense. It is like looking at an athlete's cardiovascular health rather than just their sprint speed. But even with strong fundamentals, market sentiment can drag down even the best companies. Recently, we have seen some high quality growth stocks experience sharp pullbacks. How should an investor interpret these sudden drops? Is it a warning sign or is it an entry point?
More often than not, it is a healthy correction. Markets do not move in a straight line, and pullbacks are the price of admission for long term outperformance. When a high quality stock drops 10 or 15% on no company specific bad news, it is usually just institutional profit taking or macro rotation. For a disciplined investor, that is a gift. It allows you to build a position at a discount. However, the key is patience. You do not want to catch a falling knife. You want to wait for the price to find a floor, consolidate, and show signs of accumulation before putting your capital to work.
Let's talk about the specific subsectors within technology that look promising right now. We hear a lot about hardware providers, especially the semiconductor giants driving the artificial intelligence revolution. But what about the software layer? It seems like the market is still trying to figure out how software companies will monetize these new tools.
The software transition is where the next massive wave of value will be created. The hardware phase is the infrastructure build out, laying the railroad tracks, so to speak. But the real money is made by the companies that run the trains on those tracks. We are looking at enterprise software providers that are successfully integrating predictive analytics and automated workflows into their existing platforms. These companies already have established customer bases, which means they do not have to spend heavily on customer acquisition. They can simply upsell their existing clients on high-margin value-added features. That is where we see significant upside potential.
It is about leverage and scalability. If a company can increase its average revenue per user without doubling its operating expenses, the margins expand rapidly. But let's look at the other side of the coin, the risk. With valuations still relatively high compared to historical averages, what are the primary threats to this growth thesis?
The biggest risk is execution. When a stock is priced for perfection, even a minor miss in quarterly earnings or a slightly lower guidance for the next quarter can lead to a brutal sell-off. We also have to consider the cost of capital. If interest rates remain higher for longer, the present value of future cash flows decreases, which naturally compresses valuation multiples. This is why valuation security is so important. You cannot just buy a great company at any price. You must buy it at a price that provides a margin of safety.
A margin of safety is a concept that is easy to understand but incredibly difficult to practice, especially when the fear of missing out takes over. Let's try to break down a practical strategy for our listeners. If someone is looking to allocate capital into these growth areas today, how should they approach risk management and position sizing?
It starts with a clear plan before you ever click the buy button. You need to know your entry point, your target, and your exit strategy for when things go wrong. Let's look at the current market setup. Right now, our news sentiment analysis shows a state of cautious optimism. The market wants to push higher, but it is highly sensitive to macroeconomic data releases. From a fundamental perspective, our strategy should focus on quality growth, companies with strong balance sheets, minimal debt, and solid pricing power.
And how does that translate into a concrete trading strategy? For instance, if we are looking at a swing trade versus a long term investment, how do we structure the execution?
For a swing trade, we want to align our entry with technical support levels. Let's take a hypothetical leading technology stock that has been consolidating. From a swing trade perspective, you want to identify the key moving averages, like the 50-day or the 200-day moving average. The ideal time to start investing is when the price pulls back to these key support areas and shows signs of stabilization. Specifically, you want to look for a consolidation phase where selling pressure dries up.
So rather than chasing the stock as it breaks out to new highs, we are looking for that quiet period of consolidation. Can we put some specific numbers on this to make it tangible for our listeners? What price points should they be keeping an eye on?
Let's use a concrete example. Imagine a high growth cloud software company currently trading around $180. If the stock has run up rapidly, buying at the peak is highly risky. Instead, you look for a pullback. Based on our technical analysis, a strong support level might sit around $170 to $172. That is your target price point to start investing. By entering at this level, you significantly improve your risk to reward ratio.
That gives us a clear entry plan, but what about the exit? Knowing when to take profits or cut losses is often the hardest part of investing. When should an investor decide it is time to leave the market and at what price point?
You must define your exit criteria upfront to remove emotion from the equation. If the trade goes against you, you need a hard stop loss to protect your capital. In our example of entering at $170, you might set a risk mitigation exit point at $160. If the stock closes below that level, it indicates that the support has failed and the trend has reversed. Leaving the market at that price point limits your loss to about 6%. On the upside, if the trade goes in your favor, you want to scale out of the position as it approaches key resistance levels. For this setup, a reasonable profit target or exit price point would be around $210. Reaching that level represents a clean 23% gain, which is an excellent return for a swing trade.
That structure provides a very clear framework. It takes the guesswork out of the process and replaces hope with arithmetic. It highlights the importance of discipline over emotion. As we wrap up today's discussion, it is clear that while the market presents challenges, it also offers incredible opportunities for those who are willing to do the work, analyze the data, and stick to a structured plan.
Exactly. The investors who succeed over the long term are not the ones who try to predict every macro event. They are the ones who focus on quality businesses, manage their risk meticulously, and execute their plans without hesitation. By staying disciplined and focusing on clear entry and exit targets, you put the odds in your favor.
Thank you for sharing these deep insights today. To all our listeners, remember to keep analyzing, keep learning, and always protect your capital. We will see you next time.
The information provided here and on this channel is for general informational and for education purposes only. It does not constitute investment advice, financial advice, trading advice, or any other sort of advice. We makes no recommendations regarding investment decisions based on this information. You are solely responsible for your investments. Please conduct your own research and consult qualified financial advisors before any investing.
SEO video title, Stocks 2 Trade Podcast, Top Growth Stock Picks and Technology Stock Predictions with huge upside potential stocks and pop stocks to watch now.